Want to know how elite tax advisors win the due diligence game to satisfy ultra-high net worth clients who expect the very best? Welcome to the Due Diligence Project podcast, where you get a chance to learn from the elite CPAs, virtual family office professionals, and tax specialists who are doing just that. We'll uncover their insider secrets on how they are dominating their competition, vetting new ideas, and supercharging their due diligence process to deliver extraordinary results. Bringing his 25 plus years of experience with top tax professionals across the country, please welcome your host, Alex Sonkin.
Welcome to the Due Diligence Project podcast. Today's guest is Elliott Holland. Elliott is a graduate from Harvard Business School. He is an elite professional helping family offices with their due diligence process. So, thank you so much for joining us on the Due Diligence Project podcast. We're going to talk a lot about due diligence. Obviously our group does a lot of due diligence on the tax planning side. It's always interesting for us to interview people who focus on the due diligence on the investment side. So, Elliott, thank you so much for joining us. And how are you doing today?
I'm doing very well. How are you?
I'm doing great. And this is our first recording of the Due Diligence Project podcast as we're doing this in the middle of the coronavirus situation. So obviously, before coronavirus, due diligence was really, really, really important. And now during the coronavirus crisis, we can see that due diligence maybe is even more important. I mean, what are your thoughts on that?
I think absolutely. I think our amazing world was rocking. Markets were going up, debt was cheap, the economy was good, and then you get hit with something like the coronavirus and you realize how many weaknesses businesses actually had, which are weaknesses that had you, looked at buying the business in January, 2 months in, you would really be second guessing if the diligence you considered and the modeling on the downside end was really accurate. So I think it's even more pressing now. Also, investors that are looking to buy value sort of assets, so companies that might be trading at a lower multiple, they're really going to have to do the diligence because you really don't know how long it's going to last.
Everything's changed, right? We're gonna have a fun conversation here, Elliott. Talk about your background. I mean, first of all, most people really don't understand what happens inside of family offices, what happens inside of the due diligence process, specifically what happens. How do family offices even handle due diligence? Why do they need someone like you? You talk to me about your background. You got started out of Harvard. I've heard of that school. It's a pretty good school on the East Coast, I hear. Let's just get into it because there's a lot of topics that our audience is going to be really, really interested in. So let's go.
So my background is, I call myself a reformed engineer. So I started in engineering school, realized I wasn't the best engineer. Both my parents were financial advisors, so I went down the path of strategy consulting. Went to Harvard and was just infatuated with the world of private equity. I just really thought it was a very interesting industry to be in, and I found the people here at Harvard that were in it were just so wicked smart. And so I spent a time at a $4 billion private equity firm in Boston, and then I came back to Atlanta, and the markets are a bit different here. So I partnered with a mentor of mine, and we started another group named Elsewhere Partners, where we were independent sponsors buying companies, $2 to $10 million in cash flow, and sort of putting the capital stack together during due diligence. So we were looking for companies, analyzing them, putting a letter of intent on them, looking at due diligence, going deep into finance, accounting, operations, and legal. And if everything checked out, then buying those companies. And the impetus for Guardian came during that time. What were you saying, Alex?
Yeah, I'm just curious. When does a family office bring you in? Why do they bring you in? What are the challenges that they're facing where they need assistance in the due diligence, in handling their due diligence?
So now what I see is that the family offices, many of them have invested in private equity through other instruments. So say, for instance, Alex, you're an expert in due diligence and you've been doing it forever. And we have 8 other friends who like doing deals with us. And I say, if Alex is in, I'm in. That was the previous way a lot of family offices operated.
Mm-hmm.
Now the trend is for them to go direct, to want to own their own deal, which has a lot of benefits, control. They can do something in their city, in their industry. And so they will likely find a deal, get it almost to the point of letter of intent where they have an agreement to buy the company at a certain price, and then engage with me to manage their financial, accounting, operational, legal due diligence. So I'll manage their accountants, their lawyers. I'll interview the CEO, the founders, the management team, put together a package showing them whether this business is worth what they're paying for it, and help lead that process so they can sort of focus on the deal and not be in the deep details around things they typically won't really understand.
How much do you think is the principal's gut reaction to the information versus the just analytical data crunching? I mean, where do you see the breakdown?
That's a great question. Yeah, so I would say 30 to 40% is gut feel. Why is that? And I shared something like this on my LinkedIn. Every financial package you see is up and to the right. Each and every one. There's never one that says, hey, the next 6 months are really going to be tough. This is the bad time to buy. And so you can see things in the financials that don't add up. But the real thing is when you're interviewing the founder, the person who's selling, the management team, when you talk to them about their depth of understanding of certain things, do you feel like they're telling you the truth? Would they potentially have an ability to understand their business? Would they be able to transition sales relationships from them who founded the company and typically is sort of the company? Can they transfer those to a new owner? And a lot of that's gut. So I would say 30 to 40% gut.
Yeah, and then obviously you're dealing with fears, you're dealing with expectations. What's your role? Obviously, you're the intermediary between information that your clients are asking you to analyze and also the wants and needs of your clients. You're also balancing information, feedback, input from, I'm sure, a number of advisors, attorneys, CPAs, financial people, specialists, promoters. Talk to me about that process, the challenges, and how you create results in the middle of that.
It's a hot seat to be in, no doubt. So you end up playing a role in between a family office investor who probably likes the deal, and then their heart is hoping that it's a good deal, but they hired you to make sure. You're in between a lawyer and accountant who typically like zero risk or zero-ish risk. And sometimes they'll have a relationship with the buyer, and so therefore they won't respond well necessarily to a guy like me initially, or they'll have certain traits or historical practices that might not work for this particular deal. And then you're dealing with the seller, and the most important relationship in the whole thing, honestly, even more than my client, is making sure the seller feels comfortable. So if you're in an interview with the seller and you get an answer you don't like, you eat it, because that relationship is so important. So you really have to be good at multitasking. You have to be good at analyzing not just your checklist of what has to be done, but sort of this thing that hasn't been done, what is it impacting my other item? When do I need to communicate with the family office to let them know that something might be off? And when do you need to maybe pull back to see if the seller really wants to sell? I mean, there's so many stories of sellers getting right to their signing table and not doing it. And if you're after due diligence and they're not providing data, then you might want to call it in.
I mean, what's going on right now in the world, in America, is just a humongous catastrophe for so many wealthy people, so many business owners, so many people across the spectrum, whether you had wealth or you didn't have wealth. This is affecting the entire planet. But one thing, that we want to talk about today is how important due diligence really is, all the aspects of due diligence. Obviously, when everything is good, when the economy is rolling, it's like, oh, yeah, everything's good. Hey, you did some due diligence. You didn't do due diligence. Everything's rolling. So now we have this event, right? We have this event, and it is stressful. It's like the massive stress test. So just like what happened in 2008, 2009, what happened in 2000, whenever we see these massive stress tests on the economy, one of the benefits I get to see is what's a good asset, what's a bad asset, what asset are banks willing to lend on, what are they not willing to lend on, how are they looking at collateral. And let's talk about that for a minute, because we see certain companies that have positioned themselves in a way where they're actually doing better now than they did before this thing kicked in. And then most of the companies are just doing really, really poorly. So let's talk about the due diligence process. How does a business owner navigate this and get to a great spot even when something like this happens?
I would say prudent is sort of the all-encompassing word I would use. So in the private equity game, one of the biggest decisions you have to make is how much debt you put on a company when you buy it. And one of the questions I think a lot of people have gotten caught up in during bad economies is that the banks were willing to lend on a huge, the way this works is multiples of cash flow, essentially. So the banks are willing to lend on several multiples of cash flow, and prudent buyers would not take all of that debt. So in a time like this, if you're, say, 100% equity, like Alex, your business or my business, I don't have any debt. So I can deal with a downturn much easier. If I had $1 million of debt that had to be serviced, then I might be bankrupt. And so part of what buyers have to do is be prudent with that. On the company side, though, Alex, you have to be thoughtful about what has the company done during the last downturn. And that's both the function of like their industry, but we all know companies that are in that industry that do well as a result of the management team. And so prudent buyers sort of kick tires and know cycles and have experience, so they know this business is going to be solid even if the downturn occurs.
Yeah, no, we due diligence for us is really, really, really tricky. In terms of looking at investments, when we look at an investment, we like to kind of steer away from investments because there's usually so many different risks in an investment that we can't control. As founder of the Due Diligence Project and the Virtual Family Office Hub, we get hit on by so many different providers and promoters of different types of investments. And once we start looking at it, and then we look at our entire community of clients or CPA firms and family offices, we're like, is this going to add risk? Is this going to add return? What is it going to do? How many risks are associated? We really understand all those risks. And it's really hard for us to put our name on a program because there's so many question marks, and that's not really our focus. We focus on the tax mitigation side. So we have over 200 firms, CPA firms, family offices that are all, many, 20, 30, 40 years in the tax game. And they have a tremendous amount of experience of what happens in audit, what happens in tax court. And they want to, of course, eliminate audit risk, tax court risk. And they can really understand the risk reward, cost benefit analysis of tax mitigation strategies. Most advisors, attorneys really don't get that. But CPAs who've been at the top of their tax planning game, at least that they have a fiduciary responsibility to know this. And together as an independent community, that's how we kind of get down and figure out what's good, what's better, what's best. When we look at an investment, it's like, okay, well, if the economy goes down, what's going to happen here? If the economy goes up, what's going to happen here? To me, it just feels like there's too many risks in the economic game for most investments to pass our due diligence process. So we just shy away from the fact that you're doing due diligence specifically on investments, private equity investments, things like that. How do you manage all those unknowns? How do you sift through the risk? How do you figure out this risk reward makes sense, or this risk reward, or the cost benefit versus this versus something else?
Right.
Take me into that process.
So, Alex, I'm going to start pushing it back on you, and then I'll answer the question. You've been in this a long time. At this point, when you're doing your tax planning and you're trying to help people minimize their taxes, I'm sure you have a list of things from most important, biggest dollar to least important, smallest dollar.
Yes. And
depending on how much time the client wants to spend with you, how much time and how much authority they're going to give you, what kind of analysis they want, you're going to start with the big ticket items and move to the lower ticket items over time based on knowledge you've been in it a while, Is that?
It is, also, we have to look at so many different things. We look at how does the IRS look at this? How does the IRS look at things similar to this? We have to really calculate the risk reward from a very conservative CPA's perspective.
Right.
That's where my head is at. That's where our community's at. So
here's why I like my job. So I am on the other side. So I'm dealing with people who have accepted the risk of a private equity investment.
Okay.
So they passed the risk of a public market stock. They passed the risk of a private real estate deal. And now they're comfortable with the risk of buying a private company with unaudited financials. And so what you're doing is you're using your muscle memory, right? All the deals you've been in, all the people you've interviewed, all the industry stuff you've seen, all the stuff from Harvard Business School, all the stuff from Accenture Strategy, and saying, does this business hunt? Does this dog hunt? And you're not trying to minimize risk to zero in my business. And I'm not saying that you have to ignore it, but I'm saying in my business, you want to minimize risk to less than what the buyer is paying. So if there's $5 million of risk in this, with a chance to go, say, 3-4x, then you might be willing to pay, $6 million or $4 million, an amount that's sort of less than the risk. And so you deal with these situations where you're trying to manage, hey, this business has some risk, but there's some upside here. I want the upside. And so you minimize risk by a couple of things. You put things in the purchase agreement that can minimize risk. You can make the seller bet on certain things. So if you're unsure about a particular client, so somebody has 40% customer concentration, you can say, hey, we're going to, out of the purchase price, we're going to leave 20%. And based on that client's thing, you'll get paid. We try to minimize risk to an appropriate level for the amount of money that the buyer is paying for the asset.
Got it. It's interesting because the way we do this in our community is we take an idea that's brought to us by one of our favorite family offices or CPAs. We bring it in, we introduce it to a series of elite CPAs and family office leaders. We get their feedback on the risk. We understand the reward, we understand the benefits. Those are obviously very attractive. We just want to understand the risk. And so by showing it to a number of CPAs who are very, very risk averse, we really get to whittle it down, and we keep showing it to more and more and more. We show it to attorneys, we show it to a lot, and we get all of their feedback. And based on all their feedback and knowing that, some of these people have their own things that they want to try to promote, we have to kind of, basically just sift through all that. If I was looking at an investment deal and I started showing this investment deal to a number of investors or family offices, I would be scared that one of them is going to just take the deal and steal it, or not be honest with me. So the model that we use for analyzing risk reward of tax planning strategies, we couldn't use this open source peer reviewed model on the investment side because we just think those animals wouldn't be honest with us, number one, or steal the deal if they really liked it, number two. And so that's why I was just so curious to have this podcast with you to figure out how you do your due diligence versus how we're doing our due diligence.
So the non-disclosure agreement is mission critical in our business. So when I'm talking to a family office, as soon as the engagement letter is signed, there's a non-disclosure agreement between me and them that I'll keep the deal secret. Then as soon as we're talking to our lawyers and accountants, there's non-disclosure agreements there. Talking to the bank, same thing. And because the deal environment and ecosystem is so small, you sort of know who doesn't play fair in those instances. And there's huge recourse both financially and personally for not playing by the rules. The other piece is what starting due diligence brings to the table is not just the mind of myself and my partners, but we interviewed 50, 60 different accounting firms, 50, 60 different law firms. And you might say, Elliott, what the heck are you doing that for? Well, not all accounting firms or law offices are built the same. For a very particular type of deal, 80% of the time that I'm working on, it's very important to bring the best accountants to bear, the best lawyers to bear, to really get the chance to minimize the risk to sort of the lowest point. And guardian due diligence does that because otherwise the family office would be sitting there. So I have this great deal. I think the return's high, but I can't trust the financials. Now I'm dialing for lawyers that do transactions. Now I'm dialing for accountants that do transactions. And you don't have time for that during a 90-day due diligence process, which is typical for private equity.
That's something you and I can absolutely agree on. Getting rid of your A-, B+, B players and only working with A and A+ players. We just really believe less is more. Having only A and A+ players, specialist resources as part of that inner circle, it's really, really, really critical. one of our favorite resources said it's almost when you're part of the VFO Hub due diligence project, it's like you pay for those people the wrong people not to be in the room. We only want the right people at the table because every decision is so critical. Every voice that's being given an opportunity to share, they have to come with credibility. They have to come with experience, and the more experience you have, the more we want to hear from you. Tell us something about you that maybe your clients don't even know, something private, something personal, interesting.
Let's see. Something really interesting about me. So I was the sixth child of my dad, who had 7 kids, 5 with his first wife and 2 with my mother. And so I have brothers and sisters that are in their 50s and 60s, which kind of act like uncles and aunts when I was younger, rather. So our family is like 3 generations in one. So sometimes when I go out and I have my brother come out or my sister come out, and they're like, yeah, well, that's how that happened.
That's cool. I mean, it's great to have, you have a lot of family members. You can connect with them. Family is very, very important, especially during, it's always important, especially during challenging times like this. Are you, how are you handling this situation with the coronavirus, with the confinement, all that good stuff?
I think I'm doubling down on being more focused. I don't want to be busy. That's one. I am realizing that there's some benefit in sort of being in the house, listening to more podcasts, enjoying family time more. I think you can get more people on the phone. So any phone calls that we talked before, now's the time to go try to set those up. I also think in any sort of travesty, there's opportunity. And so as much as like the news will say, crazy, bad, run for the hills, the investor in me is like opportunity, opportunity, opportunity. And you try not to be insensitive around that, but the reality is a lot of people will make money in the time. So stay in balance with being thoughtful. What are your clients looking for right now? What are you looking for? What are these opportunities that you're talking about that we should be thinking about, that our audience should be thinking about? So my clients are thinking about, where is the bottom? Is it a month out, 2 months out, 6 months out? And what they're doing is, if they're sitting on piles of money, they're kind of doing like Warren Buffett does. He kind of waits till things are really nasty. And when somebody needs a big check, he has it at a very appropriate return for his investors. And so what they're doing is kind of saying, is it now? Is it now, Elliott? Is it now? And then do we look at it now, hoping that the bottom will occur during our due diligence process? Where should we be looking? What industries? What areas? These officers that are doing investment opportunities don't really stop and like hang their hat on the wall for 2 months. And so where there is opportunity, you're trying to put them with it. And then you're also trying to have a thesis for the future. That's me at Guardian, to be able to convey that to my customers who may not be interested in doing the deal today because things are just so tumultuous. But maybe in 45 days they will, but they'll be able to do it better if they sort of have a vision for the future that makes some sense. So I think they're asking for clarity and also some clear thinking about what they should be doing.
A couple more questions. This has been great. I understand money decisions, investment decisions can be analytical, can be emotional, can be a combination.
Right.
What's your take on that? What percentage of you do you think that some of these investment ideas that your clients are making, that you're making, maybe are emotional versus analytical?
Once a buyer sees the deal that they like, they are highly emotional about it, almost across the board. And one of the things investors do over time is they have to just limit that emotional response to be more analytical, right? Yeah. So I would say most of my clients are new to the private equity game. And so they're used to real estate deals, and they work out a lot of the time. Public market stuff, the one that's going to give you 10x, look at it. And me, I'm the prudent one that knows at a letter of intent, 50% of these things don't need to close. So I would say for the inexperienced buyer, they're 60% emotion, 40% analytical, if that. And for me, I'm probably 80% analytical and 20% emotional. I try to push that 20 down to 10. Deals are exciting, but it's the time when sellers and companies sort of have the highest incentive to misrepresent things. And it's the time where you have to be from the show me state.
Exactly.
no matter what it is.
Exactly. I mean, to me, we think we do a lot of forensic analysis inside of our due diligence process. It's almost like I had a vision of, a big ball, big sphere, right? And the truth is in the middle, and you have all these different little entities on the outside and the inside of the sphere trying to provide input and feedback. And you need to do a forensic analysis of who is this player, who is this animal, why are they saying what they're saying, what's their perspective, what are they selling? Every opinion we look at is kind of tainted by something, right?
Yes.
And so we need to do a forensic analysis of all the information that we are gathering to whittle it down, to really figure this out, because emotions are involved, opinions are involved, money is involved, different motivations are involved, there's lying, there's all this stuff that happens in communication process. And so, due diligence, in our opinion, is very, very tricky. It's very, very difficult. A lot of people talk about it. Most people don't really do it very, very well. And, when we see the coronavirus situation, we see just so much destruction out there. To me, it's a result of poor due diligence in terms of just, I don't want to talk about, I just don't like making excuses. That's just me. If something goes bad.
We are so similar in that way.
As a football coach, it's like, okay, well, you can have a great reason to lose a game, but you still lost the game. And if you point away from yourself, someone else's fault, that's not a formula for success. So even when you have a coronavirus where it's obviously not the restaurant owner's fault that their restaurant,
right,
it's still, the bottom line is it happened. And the difficult thing to do is to say, what could we have done to make sure this never happens again? I just look at, me as a trader who've done so many different trades. I was a professional trader for 10 years. I am very conscious of what happens at the tail ends of that curve. Risk is real. Risk doesn't care that there's only a 1% chance of this happening. If it happens, then it happens.
You know that 1% chance is not calculated by any equation that gets you to that. I mean, as an engineer undergrad and HBS guy after, I've seen all the equations. Nothing can get you to that 1% risk. And you're right, as an investor, it's almost like being an adult. Whatever happens to you is your fault kind of thing. Even if the market plunged, even if coronavirus came, at the end of the day, there were people who did well during that, time. There are people who were better prepared. There are people who made better decisions. And you have to sort of deal with that. I mean, part of my business is giving sort of the best advice I can give at that time and trying to have some point of view on the future of sort of where are the risks, and point them out to a buyer who ultimately makes the decision.
Yeah.
I agree with you. Due diligence project, family office stuff, they're looking for resources to have a very focused point of view. For you, it's around taxes. For me, it's about private equity deals. And they want me to be their expert. I'm reading the rags of the day. I'm looking at deals. I'm looking at financials. I'm checking bank statements. And so I can very quickly get to heck no, heck yes. And if it's in the middle, then we have to, sort of kick some tires, but you can get to a level of confidence.
See, for me, what, I've been doing, I've been around finance since, 1990. What is that? 30 years now. And for me, I become a scaredy cat. I become very, very defensive oriented. And defense wins championships. I grew up with the Chicago Bears 85 defense. Their offense was okay, but they were one of the best teams ever because of that defense. And so being a professional trader, doing 50 to 100 trades a day, every day for so many years, I've learned to respect risk. Whereas when I first started, I really didn't have that respect for risk. It was more of an emotional thing. It was exciting. And I think a lot of investors out there, and correct me if I'm wrong, because they don't do 50 to 75, 100 transactions every day. They might do less than 50 transactions in their entire lifetime. They don't get a chance to really learn to respect risk until it's maybe too late. Hopefully they've had a bad investment early in life that didn't take them out, where they can learn from it and take what they've learned and bring it to future investments and have better results. that's what, when I see investors, I see that's the biggest challenge that they have is learning to respect risk with not enough transactions along the way to really get that iron to the fire.
And that's what Guardian is here for. Some people have the money and are sort of self-resilient enough to go do deals themselves. And I don't really market to them. I market to people who know that they're uncomfortable executing a transaction, know that they need help. And I'm one of the few places you can go to get this specific type of help. Family office wants to do a direct private equity deal, don't have the experience, Guardian due diligence. And so what I'm thinking about all the time is, to your point about investors, they're thinking about risk, and you don't want to get knocked out. But when they see a deal and they see like some financials that don't come out of QuickBooks, or they see a balance sheet that's not balanced, but this is not a big deal. These little things are easy to sort of push to the side and say, it's okay, it's okay. It's not okay. And also sometimes they'll have lawyers and accountants that they think will be sufficient to sort of check things. And there's places like the typical accountant is not going to look, the typical lawyer is not going to look. And at the end of the day, the investor is holding the responsibility, and there's no excuses for that individual. And so they need a champion to help them execute transactions, mitigate risk, be comfortable. I don't want these guys, biting their nails as we go through the process. Have some comfort about what's next, what's happening next week, what's happening in a month. And my former business partner, who was a mentor of mine, used to call it when you can see around corners and down hallways. So you get, it's almost like the Mike Tyson punch is coming, but you see it, so you just don't walk around the corner.
I think what you do, I think from this conversation, what I gathered is you really take the emotion out of it. I think the emotion is the culprit. The emotion is the problem. And there's no room in business for emotion. There's no room in investments and risk taking. When emotions get involved, it's usually not a good result. So having people like you and having systems in place where we take this emotional due diligence process, hey, this is it. We fell in love. This is it. We're gonna get married, and all of a sudden, that's a very dangerous thing. To have a process in place that eliminates all these feelings and emotions and just whittles it down to the bottom line, risk reward, cost benefit analysis. This is what's good, what's better, what's best. I think that is really the key to what you're doing. To bring value to your clients. That's really the key. That's what investors really need. And obviously, we don't want things like coronavirus situations ever to happen again. We don't want it happening right now. But this is the time where you can really look at your portfolio and say, what worked, what didn't work, why did that work, why did it not work, and what are we going to do moving forward to make sure that we clean up the faulty processes in our due diligence to make sure this never happens again.
And I'll tell you what, the people who have been in it as long as I have, and longer than I have, we learned through our failures. I mean, I could talk for days about things I messed up on, wasted money flying to see a guy who cloud version of QuickBooks wasn't up when I got there. People who had major contracts that were supposed to be renewed each week for 2 months. I mean, all kinds of stuff. And so you really want an experienced person doing such an important job. You have to take the emotion out of it. Most times when you get perspectives on the business or a CIM, a confidential information memorandum, it's all glossy. It looks pretty. It looks like business that's just destined for greatness. And most of the things in that presentation are marketing statements and hyperbole. And so you're right, kind of saying, hey, I see your materials. Let me just tell you, until we see these things, I wouldn't spend that much time falling in love with that presentation.
You know what? Experience. There's a lot of people out there. They're doing a lot of talking out there. I think due diligence, quality due diligence is more important today than ever because people just overwhelmed with information and they need to figure out how to quantify that information, get rid of the junk, focus on what's most important. And I think you're hitting the nail on the head. We need to take advice and listen to people with massive experience who've experienced failure, who've gone down many wrong roads and figured out how to get back on the right road. If you have a network and community of people like that across many different spectrums, and you show them things, the feedback you get from those people is very, very different from people, someone who's been in the industry for 5-10 years and is basically a salesperson. To me, that is especially if they're a really good salesperson, that to me is a very dangerous person. No experience, great marketing, great salesmanship. That is a recipe for disaster. But you need people.
It's terrible, Alex. It's terrible because people will represent that they've done things that they haven't done. And then people will sort of overextend sort of their gray hairs and experience in some other things to assert that they're excellent in this thing. And I think part of the buyer's exercise is to make sure that
see Elliott, that's what I'm saying. This is what I'm challenging. It's like if I go into an area like an investments or things like certain various investments that maybe I don't have experience in, all of a sudden like I don't want to go there. Come out to the deep water with me. Let's go swim out to the deep water with me in the field of sophisticated tax planning. You want to try to spit some game at us. You want to try to promote something that's got risk on it. Guess what? We've got the biggest, most experienced tax people in the world. They're going to see through your stuff in about 5 seconds. And so we only operate in that deep water of very, very sophisticated tax planning where very few people even want to venture out, and very few marketers and promoters can even get away with taking a couple strokes out there because they just don't even want to go out there because this is way beyond them.
And then for me, Alex, I end up with typically the buyers will show up with the seller gave them, which can be as little as the last 3 years' tax return. And we all know that's a funky representation of a business. Or maybe financials that are print out of QuickBooks with stuff in it like Ask My Accountant in the middle of the income statement, or statements that actually don't reconcile with each other. A lot of times, particularly in smaller deals, you have to sort of see what's there. I remember looking at one company that didn't even have QuickBooks. I mean, like you said, when you're able to say, hey, we can get into the deep water. I've been here before. I actually know the sharks. They don't play with me anymore. We're friends. And I can protect you. It's really the service you provide so they can go get this deal done, feel comfortable. And then get back in their comfort zone where managing a company, running a company is a lot different than making sure the company is as it's presented.
Elliott, I think this is great. I think our audience has gotten a lot of tremendous value from just hearing you. Thank you so much for joining us. We really appreciate you being part of the Due Diligence Project and Virtual Family Office Hub. Take care of your family. Stay safe out there. And thank you so much for your time today, my friend.
Alex, thanks for having me.
All right, sir. Thank you. Bye-bye.
That's all for this episode of the Due Diligence Project podcast. Be sure to visit duediligenceproject.com to access the resources we have available for qualified CPAs and family office leaders. Our mission at the Due Diligence Project is to help you deliver more significance and value to your very best clients while shifting your traditional practice into the firm of the future.